Hey everyone, welcome back for another deep dive. We're tackling something totally new this time, alphaeconomics. We've got excerpts from, let me make sure I get this right, alphaeconomics, the informational underpinnings of market efficiency. And this is, well, it's not your typical Econ 101 stuff.
Not even close.
Yeah.
You know, the whole markets are efficient idea. Like, prices are always right because theoretically you can't predict future returns.
Right.
Well, this research digs way deeper. It's kind of like, yeah, the ocean is a sea level, but what about the waves, the currents? That's where it gets interesting.
Okay, I like that analogy. So instead of just saying everything's priced correctly, we're looking for those mispriced waves. But, and maybe this is a dumb question, why even bother? Most of us aren't like day traders glued to the screens. What's the takeaway for regular investors?
Because those waves, those are potential market-beating returns. Think about it. Trillions of dollars are managed by pros trying to do exactly that. Why? Because mispricing exists, and getting why it exists, even if you're not running a hedge fund, that can give you an edge.
So there's hope for us little guys, but if these opportunities are just out there, why isn't everyone like piling on?
That's where it gets really interesting. Lee and the authors, they talk about noise traders. Basically, think emotions and biases. These aren't robots. Fear, hype, all that drives decisions that can actually push prices away from what they're really worth.
Wait, so you're saying our own humanness is what creates the opportunity? Feels like that could be, I don't know, exploitable. Isn't that where the really savvy investors come in?
You got it. One way to cut through all that noise? Good old-fashioned fundamental analysis. Remember Benjamin Graham, the OG of value investing?
Vaguely, yeah.
His stock-picking strategies, they're almost 80 years old, but they still hold up.
Seriously, something from the 1940s is relevant today. That's wild. What's the secret?
It boils down to finding quality companies at good prices, like finding hidden gems the market's overlooking. And this isn't just anecdotal. There's actual research. Curtness, he's a well-respected researcher, found that companies with strong fundamentals outperform, even when you account for risk.
Hold on, that kind of goes against everything I thought I knew about risk and reward. Explain that like I'm new to this whole thing.
Okay, so the usual thinking is higher risk, higher potential return, right? But Asmus's research throws a wrench in that. He found companies with solid track records, profitability, low debt, steady growth, that kind of thing. They often do better, even if they aren't the sexy picks.
So it's about looking past the hype and at the actual strength of a business. Makes you wonder what else the market's missing.
Exactly. And that's where arbitrage comes in. Ideally, when there's mispricing, someone would buy low, sell high, pocket the difference. But it's not that simple.
Because of course it isn't. Nothing in finance is ever simple, right? What makes it so complicated?
Well, Lee and So point out, real-world arbitrage is expensive. Finding opportunities, getting the money to invest, making the trades, it all adds up. Those costs can make some opportunities just not worth it, which is why mispricing can stick around.
So even if you spot something undervalued, it might not be worth the effort, the cost to try and cash in. That's frustrating. But if it's not as easy as buy low, sell high, why does value investing even work?
That's the million-dollar question, right? Lee and Silver. So dive into a bunch of explanations for why, despite the challenges, it can work. One of the most interesting, behavioral biases.
No, those, I've heard of those. We all have them. How do they fit in?
Well, one they talk about is saliency bias. Basically, we tend to overemphasize stuff that grabs our attention, even if it's not that important in the grand scheme of things.
Okay, yeah. Like judging a book by its cover, even if the story inside is terrible.
Exactly. We latch onto a good story instead of digging deeper. And then there's overconfidence, especially when there's a lot of, uncertainty.
So, like those young companies. Lots of buzz, but no real track record.
Exactly. Investors get caught up in the hype, overestimate the potential, boom, inflated prices, which eventually correct, by the way.
So how do we avoid these traps? It's like we need to be part-time detectives, part-time therapists, just to invest.
You're not wrong.
Yeah.
And that's actually why, Lee and Silver, so they spent a good chunk of the monograph talking about research methodology.
Okay.
They want to give us the tools to be skeptical, to evaluate these studies on market predictability, and tell what's real, what's just hype.
Give me the cheat sheet then. What should we be looking for?
Well, they're really big on avoiding data mining, or data dredging, as some call it. Basically, if you analyze enough data, you're going to find patterns, even if they're totally random.
So some research might just be finding flukes, not real repeatable patterns.
Exactly. It's like you flip a coin enough times, you'll get a long streak of heads. Doesn't mean you can predict the next flip, That's why testing strategies over different time periods, different market conditions, that's crucial. Something that works great in a bull market might totally tank when things go south.
Makes sense. They also talk about transaction costs, right?
Huge point. Even a brilliant strategy is useless if fees eat up all your profits.
Right, those hidden costs. Speaking of costs, we talked earlier about the cost of arbitrage, but they also mention limits to arbitrage, right? What does that even mean?
So just because we can see those mispriced assets doesn't mean they'll snap back to their real value overnight. There are things that prevent even the smartest investors from totally erasing mispricing.
Like what? If someone sees an opportunity, wouldn't everyone else jump in?
You'd think. But first, arbitrage takes money. And getting that money, that has a cost. Interest rates, fees, or even just what you could be doing with that money elsewhere.
So you might see the opportunity but not be able to act on it.
Exactly. Then there's the risk that, well, the mispricing gets worse before it gets better. If you're leveraged, meaning you've borrowed money to invest, those losses, they sting a lot more.
High stakes. No wonder there are limits to how much arbitrage can really happen. But even with those limits, there are people who seem to beat the market consistently. How do we explain that?
That's where things get even more interesting. Remember how we were talking about Benjamin Graham? His focus on fundamentals?
Yeah, finding those hidden gem companies?
Well, one investor took that idea and tried to, quantify it, turn it into a formula.
Hold on, a magic formula for investing. Tell me more.
Not quite magic, but it's close. Joel Greenblatt, he's a successful hedge fund manager. He wanted to see if he could capture the essence of, Warren Buffett's style, but in a formula. He called it the magic formula.
Okay, I'm listening. Break it down for me. What's so special about this formula?
It's actually really simple. It's based on just two things, return on capital and earnings yield.
Okay, so return on capital, that's like how well a company uses its money to make more money, right?
Exactly. It's a measure of how efficient and profitable a business is. You want a company that's not just making money, but using its resources wisely.
Makes sense. What about this earnings yield?
That tells you how much profit a company is generating compared to its market value. It's a way to measure, cheapness. The higher the earnings yield, the more bang for your buck you're getting.
So the magic formula is looking for companies that are both profitable and cheap. That sounds almost too easy. Does it actually work?
Well, Greenblatt, he backtested it over decades, and guess what? It consistently outperformed the market. It suggests that combining a focus on quality with a disciplined approach to valuation, it can lead to some really strong returns.
Wow, that's impressive. It's a good reminder that sometimes the simplest solutions are the best. But before we all run out and start applying this formula, are there any caveats, blind spots?
Of course. Every formula, every strategy, it has its limits. What works in one market might not work in another. And past performance, well, it's never a guarantee of future success.
Right, it's not a crystal ball. So the magic formula is intriguing, but we can't just blindly follow it and expect to get rich quick.
Exactly. It's one tool, and it's important to use it within a broader framework. Understand the market, those behavioral biases we talked about, all of that.
Okay, this is all starting to click. So we've got our fundamental analysis, we're watching out for those biases, maybe even playing around with the magic formula. Anything else we should be thinking about?
You know what I found really fascinating? Lee, and so bring up how totally unrelated factors can influence how the market behaves. They call it the sunshine effect.
Sunshine effect. Does that mean I should be checking the weather before I buy stocks?
Not quite. But researchers found a link between sunny days in New York City, where Wall Street is, and positive stock returns. Cloudy days, returns tend to be lower.
No way. You're saying investor mood, even if it's affected by something as simple as the weather, can actually move the market?
It does seem strange. But it shows how much psychology plays into these financial decisions. It's not just sunshine. Studies show things like holidays, even big sporting events, they can all impact investor sentiment and then, in turn, the market.
Wild. So we're not just up against algorithms and spreadsheets, but our own collective moods.
In a way, yeah. And it just shows how important it is to understand these behavioral factors if we want to really grasp how the market behaves.
This has really given me a whole new appreciation for how complex the market is. It's not enough to just crunch numbers. We have to understand human behavior, too.
Exactly. And this research shows how all these threads, information, sentiment, the limits of arbitrage, they're all woven together.
We're peeling back the layers of an onion.
Exactly. And as you go even deeper, Lee and So, they hit us with one final thought-provoking question. One that makes you wonder about the whole future of investing.
Okay, now you've got me on the edge of my seat. What's this final thought? Okay, you said this last thought is a real head scratcher. What is it?
They ask, if information is so key to market efficiency, how might this explosion of big data, these crazy algorithms, change how investing works?
Wow, yeah. I mean, it feels like we're drowning in data already. Are we headed toward like hyper efficient markets where any little mispricing is instantly, I don't know, gobbled up by some algorithm?
It's possible. More data, faster processing algorithms could theoretically spot and exploit these mispricings way faster than any human.
So those market waves we've been talking about, they'll be invisible to us, regular folks. Will there even be opportunities for, the average investor anymore?
That's the billion-dollar question.
Hmm.
And while it's tempting to think, yeah, algorithms just iron out all the inefficiencies, lean and well, so they suggest something else might happen.
What's that?
New complexities,
Hmm.
new biases even.
Wait, hold on. More information leading to more bias. How does that work?
Well, think about it. Algorithms, they're only as good as the data they get, right?
Hmm.
And the assumptions of the people who program them. So if the inputs are flawed, if they already have biases
And
built in,
output's going to be messed up too. Garbage in, garbage out.
exactly. And even with perfect data, there's still the interpretation. We've already seen algorithms latch on to totally random stuff or amplify existing biases because they don't know any better.
So it's not just about how much information, but how we use it. Are you saying human judgment is going to be even more important in the future, not less?
Absolutely. We need to tell the difference between a real signal and just noise. We need to understand what these algorithms can't do and question their assumptions constantly.
This whole conversation has been a wild ride. We started with finding mispriced assets, then those behavioral biases, the magic formula. Now it's the rise of the machines. For our listeners trying to make sense of it all, what's the biggest takeaway?
Investing, it's changing so fast, getting more complex every day. But some things stay the same. Information, even if it's not perfect, that's what drives the market. Investor sentiment, all those quirks and biases, that's still shaping prices. And because taking advantage of these things has a cost, mispricing, it's probably here to stay, even in a world run by algorithms.
So this whole alphaeconomics thing, learning how information and behavior are connected, it's more important than ever.
Exactly. The playing field's different, but the rules of the game, they're surprisingly familiar. What we've talked about today, it gives you the tools to not just survive in the markets, but to adapt no matter what the future holds.
I'll be honest, I get overwhelmed sometimes, so much information out there. But this conversation, it's actually made me feel more in control. Like, instead of chasing the latest hot stock tip or trying to outsmart some algorithm, I can just focus on really understanding how this all works.
That's the spirit. That's what separates the successful investors from the rest. It's not about having all the answers. It's about having a good process, making sense of things, and avoiding the common mistakes.
Well said. This has been a truly eye-opening deep dive. From hidden gem companies to the sunshine effect, even the rise of the machines, we covered a lot of ground. A huge thank you to our expert for being our guide on this journey.
Happy to do it. And remember, the best investment you can make is always in yourself. Your knowledge, your judgment, that's how you navigate this crazy, wonderful world of investing.
Couldn't agree more. And until next time, keep diving deep, keep asking those questions, and happy investing, everyone.